Greetings, everyone, and welcome back for another episode of QX Institutional. I am Anaïs Frank, the founder of QualitaX, a technology company focused on DLT-based digital transformation in the financial sector. Today is September the 4th, and this episode is brought to you by the teams at QualitaX, Bluechip, and RWA World. Our partner, Bluechip, is an independent stablecoins rating agency, and our other partner, RWA World, is a technology and research firm focused on tokenized assets. Unfortunately, for today's episode, Gareth Jones, Chief Economist Officer at Bluechip, will not be able to join us, but he will be back next month for the September roundup. So let us jump straight in with part one, DLT and blockchain in finance. And to get started, Bloomberg added Polymarket election data to its terminal. For those who do not know, Polymarket is the world's largest decentralized prediction, or we can call it information market, and it is built on Polygon. As you can see here, you are free to express your views about potential outcomes of various events, not only political, but also sport, business, and science. And here it's a screenshot of the terminal. As you can see, presidential election winner 2024, Polymarket, prediction market here. So if we go back to Polymarket and I click on this event, you're able to see that almost, how much is it? 800 millions worth of bet, with the most likely outcomes being Donald Trump and Kamala Harris. If you click on View More, you're able to see the other options here. So it is a very interesting development to have Bloomberg terminal users now having access to crowdsourced decentralized probability estimates on these events. And it would be quite interesting to note to what extent this can actually influence decision making in traditional finance, if it does at all. The fact is that a major financial data provider has now integrated with a decentralized product that incorporates in some way some DeFi components. So it is definitely another step towards the convergence of traditional and decentralized finance. In other news, Centrifuge has launched an institutional real-world asset lending market on Coinbase, this Base network, so the layer 2, using Morphovaults. So what does it mean? Now, investors holding tokenized treasuries, and it's actually written down here. Up. So I was saying, now investors holding tokenized treasuries do not need to redeem their underlying T-bills if they are in need of liquidity. With this new credit market, they can borrow against three types of tokenized US Treasury bills. So the Centrifuge Anemoy Liquidity Treasury Fund, the Midas Short-Term US Treasury, so MT-bill, and Ashnot USYC. So what makes it even more interesting is that it seems that it is a permissioned lending market that is leveraging Coinbase verification. By using the Coinbase verified on-chain attestation, Coinbase customers who are already KYC'd are able to access various apps and other on-chain benefits, such as this new centrifuge market. I want to highlight that Coinbase Verifications is leveraging the Ethereum attestation service, which is a public good for making attestation on-chain or off-chain about anything, as you can see here. I am personally hoping that as more institutional players are entering the space and more products are being developed to meet their needs, a portion of the capital and resources will be allocated towards supporting and enhancing public good infrastructure and open source projects such as the Ethereum attestation service. In other news, more traditional financial products are also being launched on public networks, this time from traditional private market firms such as Hamilton Lane. As you can see here, they have launched their secondary fund 6, which raised 5.6 billion, and it's now accessible to qualified individual investors through the Securitas platform. The fund is tokenized on the Polygon blockchain, so the minimum investment for this has been reduced from 5 million to 20,000. Where was it here? 5 million to 20,000. So it definitely broadened access to the private equity secondaries. Also in August, Franklin Templeton launches money market fund on Arbitrum. So this is the US government money fund FOBX, which has been launched first on Stellar and then on Polygon and now it's on Arbitrum. So individual investor can access FOBXX using the Benji Investment mobile app on Apple and Android devices, while institutional investors can access it through the Benji institutional web portal. Yes, so as you can see, it does not seem that there is a lot of activity on Arbitrum so far, with only three holders and a bit above 500,000. This is very small in comparison to the above 420 million on Stellar with almost 500 holders. And while we are here, I am happy to announce that Qualtex received a grant from the Stellar Development Foundation back in June last year to work on a project focusing on developing an EEA-compliant interoperability solution between Stellar Soroban and Polygon. As you know, we are co-chairing the Enterprise Ethereum Alliance DLT Interoperability Working Group with OneChain. Our working group developed the EEA DLT interoperability specification, an open standard for interoperability between different DLT networks, focusing on enterprise applications. As you can see here, it covers three layers: the messaging layer, the function call layer, and the application layer. And it includes requirements and considerations for interoperability with Corda, Algorand, Stellar Soroban, Cosmos, and Fin P2P. This is quite an extensive specification. I will leave the link in the description box below if you are interested in learning more. So if you go back to this dashboard here, we can see that issuers such as Franklin Templeton, they are launching on-chain products on various networks, and they also announced the peer-to-peer payment functionality. So with the EA compliant Stellar Soroban Polygon Asset Bridge, we are aiming to complement such initiative by enhancing liquidity, improving interoperability, and expanding market reach for issuers by allowing stakeholders on one network, for example, on Stellar here, to sell their digital asset to buyers on other networks, such as Polygon. So far, we have been quite US focused in the news. So, some news from South America. The e-commerce giant Mercado Libre has launched a dollar-backed stablecoin called Dollar in Brazil, which is its largest market. If you are not familiar with this part of the world, Mercado Libre serves 18 countries in the region and has a revenue, well, as per 2023, of around 14 billion USD. So the stablecoin will be pegged one-to-one to the US dollar and will be available to all Mercado Pago clients through the company app. So this really expands their digital asset offering, which already included Bitcoin and Ether trading. Dollar, interestingly, will be fee-free for clients, and Ripio will be serving as the exchange and market maker. Also, the Asian Infrastructure Investment Bank, AIIB, has issued its first digital native note, raising 300 million on Euroclear DLT platform, which is Corda-based, and which is called the DFMI platform. This marks the first digital USD issuance for Euroclear and the first by an Asian-based issuer. So this is a AAA rated bond, and it is listed on the Luxembourg Stock Exchange. It is a milestone that demonstrates the growing adoption of digital assets in financial markets, and also a commitment to the established stakeholders such as Euroclear in embedding emerging technology for financial market infrastructure. Naxitis, I will not pronounce this, and DekaBank have issued Germany's first digital registered covered bond on the SWAT blockchain with a 100 million volume. So by using blockchain, they enable same-day settlement, improve tradability, and reduce risk. Lido, the largest liquid staking platform, has launched Lido Institutional, a B2B white glove service for institutions. So this service addresses AML and KYC concerns, and it allows institutional clients to mint new STEs without transaction history. Lido aims to grow from its current 25% institutional TVL to 50%. And their approach is to offer a more decentralized alternative to centralized staking service. And finally, in August, we also released our paper on ERC 6123, a deep dive on financial derivatives, particularly smart derivatives, in collaboration with stakeholders from DZ Bank, the Enterprise Home Alliance, Tokenovate, Hackend, Kaleido, and others. If you are not familiar with ERC 6123, it's a specification to manage and settle derivative contract on-chain. So if you think about it, and I will go to this page, in TradFi, we have traditional financial instruments, and over the last 18 months, we have seen more and more tokenized financial instruments. This specification is really focused on developing and supporting native on-chain financial instruments, particularly on-chain derivatives such as swaps. A good use case in traditional finance could be interest rate swaps, and in DeFi, it could be Ethereum staking rate swaps. So the document first include an overview of the current state of the derivative market and the different type of derivatives, with a key focus on non-clear OTC derivatives. Then we address the challenges in the traditional OTC derivative markets in terms of margin, counterparty default risk management. And then we dive into the technical specifications and the different mechanisms introduced by ERC 6123. So if you are interested, I invite you to read this document. As you can see, it's quite extensive, 57 pages. We also cover a set of use cases and case studies because there have been already some test and pilot of using ERC 6123 in traditional finance. So we cover those as well. And we also have a section focusing on the technical breakdown of the key method, the events, etc. One thing that you may find useful is actually the last table, figure 11, that summarizes the key benefit and improvement that are being delivered when using ERC 6123 versus the current ways of doing things, the current as-is processes here. All right, that is it on my side. Please keep watching for more news from Tyler and Ray on the world of real-world tokenized assets. And I see you next time.
Hey everybody, and welcome to another episode of QX Institutional. My name is Tyler Sherwin, and I'm joined by Ray Buckton, our head of research at RWA World. Today we're going to be talking about updates for the month of August. But first, a little bit about RWA World. RWA World is a technology and research firm focused on tokenized assets. It's our mission to bring clarity and transparency to the world of RWAs, and we do this every week with our newsletter, which you can find at RWA World. Ray Buckton is the author of our weekly newsletter, and he'll be joining us on this call today to share updates from three major areas: regulatory updates, institutional updates, and ecosystem updates. So Ray, kicking us off, let's talk about this inflection point that's happening in tokenized assets, particularly the Treasury bills market. What's been happening in the month of August?
Yeah, absolutely. Huge milestone hit in August. We had a $2 billion market cap threshold reached for tokenized treasuries. That's just 5 months ago. We hit the 1 billion. So things are accelerating really quickly. This is on the heels of MakerDAO, as you see at the bottom here, coming out as a new allocator to RWAs. They want to put up $1 billion themselves into tokenized treasuries specifically. So we should have 3 billion in no time. This pales in comparison to the $100 billion plus market cap of stablecoins. They've really found their product market fit. And if you believe folks who are deep into the industry, like Carlos Domingo, CEO of Securitize, who says that tokenized treasuries will always intrinsically lag stablecoins, nevertheless, we're seeing a huge acceleration of overall adoption. We've also seen Kaiko Research come out this week, and they were saying that while a potential change in Fed rate policy may ultimately put a damper on some of the rate of adoption, ultimately it's not going away due to the fact that the fundamental value and benefits that are endowed to the underlying asset when tokenized, they can't be undone. So even though this may slow down should rates shift, this is the thing that really kicked off the entire tokenized asset craze to begin with. So I don't see any signs of this slowing down unless we have a change in rate policy. And should we, well, ultimately it will slow, not stop.
Yeah, I think well before we ever plateau on the T-bill market cap for tokenized assets, I think we'll be seeing massive growth numbers. So next month, who knows? It could be another billion added here. So let's talk a little bit about the institutions that are, of course, driving a lot of this adoption in the world of tokenized assets. Ray, could you talk us through a couple of these headlines?
Yeah, 100%. So a lot of the rate of tokenization that we're seeing comes from the legitimacy that is being lended by institutions. And some of that comes from the familiarity that these institutions are now seeing in existing public blockchains. Particularly, and most surprisingly to me, is the risk of centralization in Ethereum. Beaverbuild is the entity, according to Ledger Insights, that was responsible for over half of all blocks built on Ethereum for the month of August. Now, something to underline is that the building of blocks is different from the validating of blocks. While we have 1.3 million nodes on Ethereum that are validating, the actual putting together of the block to be validated is a different thing entirely. And Beaverbuild is responsible for half of those in August, again, according to Ledger Insights. And also, Ethereum is now utilizing dark pools, not natively to the ecosystem and the environment itself, but by the entities who are transacting on it. Dark pools are quasi-private transaction environments utilized by very large banks who don't want to impact the equity markets when transacting amongst themselves, and now we're seeing that technology make its way onto the world's largest smart contract network. Particularly these entities that are using dark pools on Ethereum are not perturbed, but dissatisfied with MEVs, sandwich attacks, and other kind of extractive technological approaches. And being that it's a public network, these sort of things are unavoidable lest you have a semi-private configuration on Ethereum. According to, again, our friends at Ledger Insights, up to 30% of transactions have flown through dark pools on Ethereum, which is very interesting. But ultimately, again, this is something that's familiar to existing institutions due to centralized financial practices. So Franklin Templeton and SBI Holdings, for example, they're very comfortable with this, hence why they formed a JV, a joint venture, for digital assets in Japan. And speaking of the Japanese market, Sony has launched a testnet, an incubator for Sonium, which is a layer 2 blockchain. Layer 2 blockchain being a dedicated blockchain that ultimately attests its data to an underlying blockchain, in most cases, of course, Ethereum. Also, a little bit of envy. We've seen the dam break, a watershed moment. NASDAQ is now looking at NYSE with a bit of, let's say, jealousy in their eyes, because they're also launching Bitcoin options. So now that the cat is out of the bag, canary into the coal mine, no one has to be the first one in anymore. We're seeing a lot of adoption happening in terms of institutions.
Yeah, I would characterize the theme as just infrastructure developments. You know, these platforms like Sony, for instance, maybe they are more comfortable interacting on their own blockchain than they might be in Ethereum. As you mentioned, some of these private entities are more used to these centralized configurations. And Sony's layer 2, I'm super excited about, because I'm very curious what types of use cases, what types of creators can use a unified blockchain experience across all of Sony's different products. And so this is something we're going to watch very closely, and we're seeing an emergence of specialized layer 2 chains. Ray, how many layer 2s are out there, and can the market continue to sustain new layer 2s coming live every day?
Well, according to L2Beat, which is an entity dedicated to tracking this sort of thing, we're seeing, I believe it was 74 active layer 2s and over 81, 82, I believe was the number, that are in the pipeline. So by the end of this thing, we'll have over 150, and this is showing no signs of slowing down. Ultimately, though, this is kind of leading towards that multi-chain future we've all been talking about. And if it all attests back to one main chain or just a small handful of main chains, then ultimately we may have the scalability we're all looking for.
Very exciting. Something we'll be watching closely. One thing, of course, though, we can't ignore is the regulatory developments. And I do still anticipate that we'll get more clarity after the election. But for the month of August, tell us, Ray, what were some of the things that happened we should be paying attention to?
Yeah, absolutely. So, of course, the ongoing case with Ripple and the SEC looks as though to finally be taken care of. Ultimately, Ripple was fined at the end of it $125 million, much less than the $1 billion that the SEC was looking for. And interestingly, they're barred from future violations. I don't think this means that the SEC is implicitly saying everyone else is okay to violate the law, but this is a very nice moment for Ripple because it means that all of this is now in the past. They are officially not a security, so congratulations to them. Additionally, the SEC has issued a Wells notice to ever-popular NFT trading platform OpenSea for the alleged issuance of unregistered securities. Now, this is not the first Wells notice that the SEC has issued to digital asset companies and crypto companies. Even this quarter, they've issued a large number, including to Robinhood Crypto and to Consensus, the large entity that helps to support Ethereum. So it'll be interesting to see ultimately with some of the practices that OpenSea undertook last bull market cycle, whether or not they're able to squeak out of this one. They definitely were doing some interesting things as it pertains to, let's just say, pumping their bags, you could say. And also, Tyler, I'm interested to ask you. You have a lot of experience with the kind of regulatory side in terms of compliance in the banking sector in the United States. Customers Bank was ordered to limit their digital asset exposure by the Federal Reserve. What do you make of that?
Yeah, well, I would characterize these three developments as, two pieces of bad news and one piece of good news. So the Ripple case, definitely some good news. Being barred from future violations, that is a pretty funny threat. It's kind of like what you might say to your kids, hey, don't break my rules in the future. You are prevented from doing that. But of course, we'll take what we can get with that. I was really hoping to do another one of these QX episodes without a SEC's Wells notice in our news. Unfortunately, here we are with, of course, OpenSea, the trading platform, getting one of those. And with regard to Customers Bank, this is something I'm very familiar with, spending the last 3 years at a fintech infrastructure bank similar to Customers Bank. I've seen behind the scenes what can happen when FDIC regulators are pretty unhappy with and unfamiliar with digital asset related businesses. And so in this particular example, Customers Bank has been asked to limit their digital asset exposure by limiting the types of clients that they onboard. Specifically in the digital asset industry. And this is quite an aggressive stance that I think really needs to be called out. Some are calling this what is called Operation Choke Point 2.0. And a very short summary of what this means is back in the Obama administration, there was an operation called Choke Point with the FDIC regulators who essentially, without making any formal policy comments, pressured banks to not bank certain industries that were deemed politically unsavory at that time. That was called Operation Choke Point. And now we are experiencing this again, and due to a lot of amazing research from people like Nick Carter, who have written extensively on this, there is now essentially a renewed focus on this sort of pressure to FDIC regulated banks, where they will give guidance, comments, off the record instructions, and in many cases, after the fact, reprimands, much like this, to limit their exposure to certain industries that are deemed unsavory. As we've seen during the last 4 years, there's been a ton of pressure placed on banks that are wanting to work with digital asset clients. This was something I saw firsthand in my last role before beginning my work here at RWA World. It's something that I'm afraid is going to only continue until we get a change in leadership, either at the FDIC, change in leadership in the current regime and our political situation. We'll see what happens. It's something that I'm never happy to see. The banking industry does need to support the blockchain industry. Without it, blockchain industry does not have fiat on and off ramps into and out of this amazing ecosystem that we call home. So I'm hoping that these sort of activities will be reduced over the next several months. I'm hoping next month's update that we do doesn't also include more bank crackdowns on digital asset industries. So let's also talk about, what does this ecosystem look like for the last month? There's been a ton of stuff that's been really good news. So let's shift from the negative regulatory side, Ray, and tell us what are some really exciting developments in our ecosystem?
Yeah, absolutely, and no shortage of those, that's for sure. MakerDAO, as we mentioned, they plan to allocate $1 billion to tokenized assets, particularly treasuries, majoritively. But they've also rebranded to Sky. With all these institutions knocking on the door and showing interest, the idea of a DAO being fully decentralized ultimately doesn't necessarily bode well with centralized institutions who want to have known counterparties and particular channels that they can communicate with. So seeing MakerDAO rebrand as Sky is something that's definitely an interesting shift and something that maybe we should expect from some more well-known entities. Tether as well, they are fighting Celsius. No, not the energy drink. They are fighting the giant asset manager that ultimately went kaput last cycle. And they were able to repay $2.5 billion, which is over 80% of capital to creditors as of last week. But nevertheless, they are fighting tooth and nail to get any penny back from anyone. Anyone who's withdrawn over $20,000 from the platform was named in a class action lawsuit with Celsius as the plaintiff. And the actual withdrawal drawees as the defendants. So they want Celsius wants their money back to distribute more equitably among those who are owed the capital. And Tether says no dice. Tether is actually fighting this lawsuit tooth and nail, saying that it is predatory and extractive and has no real basis in actual law and reality. That all stems back to a withdrawal transaction that was submitted by Celsius to Tether, so I guess you could say Tether has the receipts. And what's interesting is that the actual value of the underlying assets that Celsius had in escrow during this bankruptcy case have appreciated massively, similar to the Mt. Gox situation where ultimately, hey, we have a handful of Bitcoin, but now instead of being worth $100, this Bitcoin's worth now $60,000. So squaring that circle of how these assets are distributed is very interesting. Also, MetaMask, the world's most popular Web3 wallet with one of the most clunky, interesting user interfaces, you could say. Definitely not ready for mainstream adoption, but that could potentially change. They're rolling out a blockchain-based debit card developed in conjunction with MasterCard and banks. And of course, some very exciting news that we're happy about. RWA World, yours truly, has partnered with Segment, a wholly owned subsidiary of VanEck Europe. We are working very closely now, particularly with Segment, on dashboarding services for tokenized watches and other collectible assets. So keep an eye out for that and some exclusive research that will be issued on Segment's website in the very near future.
Hey, look, we're in the news, right? I love this.
We made it.
So just real quick on that last piece of news, we are partnering with an amazing platform called Segment, which is essentially like a Web3 eBay that VanEck is very excited to be launching, and it's been making some progress since February this year was when they began. And our role with them is very exciting. We're focused on building out API solutions and data providers to the platform. So ultimately, the users of Segment are going to get access to high fidelity data that we are sourcing at RWA World. So stay tuned for that. We'll share more updates on that. As you can see, a ton of exciting ecosystem developments in the world of tokenized assets, and it's always fun when we can make the news on our end. So speaking of, we also have a very important event that we want to share with our audience, which is that we are hosting an in-person event at the Permissionless Blockchain Conference in October. It's taking place in Salt Lake City, and our event is happening the day before the conference begins. We're calling it RWA Day. It is an exclusive roundtable networking event focused around helping our friends in the real world asset industry get to know one another and find business opportunities in the world of tokenized assets. It's going to have an emphasis on roundtable dialogues and breakout sessions rather than a bunch of panels that you sit through and do not get to participate in. Instead, everybody's a VIP, and there's a very big emphasis on a curated audience of people who you really want to meet if you're excited about real world assets. Attendance is free, and we have sponsorships available. The event is again on October 8th. We have a couple months before the event happens, but time flies very quickly, and we want to make sure that you get the chance to join this event if you're interested in it. So you can find out more at rwa.day. And on the bottom of the screen here, you can see a lot of the different institutions and sponsors and attendees that we have coming to the event, including our partner VanEck, who we're very excited to welcome. So I hope that we will see you at RWA Day. And of course, this has been RWA World, providing insights on the QX Institutional series focused around updates in the world of regulatory, institutional, and ecosystem developments. If this was interesting to you and you want to hear more from Ray, our head of research, who writes our amazing newsletter, I strongly encourage you to check out our website, rwa.world, where you can subscribe to our newsletter, which has insights curated from over 420 different projects in our database. This database is the largest publicly available database of real-world asset companies, tokenizers, layer ones, and marketplaces. So I hope you will check it out. We put a lot of effort into this. Ray, any last words before we close?
No, thank you all so much for joining us, and we will see you in the next one.